A quiet warning just came from one of the most influential investors of the last 50 years. And if he's right, then the hedge fund model Wall Street relies on today, the one behind billions of dollars of daily market flow, may not survive the next cycle. And the timing of this warning is not random. It comes at the exact moment markets are shifting into a regime multi-strategy funds weren't designed for. Higher rates, tighter liquidity, and more violent cross-asset swings. This isn't about returns. It's about structural fragility, a weakness that stayed hidden because the model was so profitable. And Ray Dalio just said the quiet part out loud. If you've traded a stock, checked an ETF, or watched tech stocks rip higher, you've felt the influence of multi-strategy pod shops. Citadel, Millennium, Balyasny, Exodus Point. They allocate capital to dozens or hundreds of small teams, each running their own book. It's a machine built for steady gains, tight risk control, and massive diversification. But Dalio's point is simple. A model can be wildly profitable and still be structurally fragile. And fragility matters more than returns when the cycle turns. On Bloomberg's Odd Lots, Dalio didn't criticize performance, or AI, or strategy. He criticized the architecture of the pod system. It's not a fine way for building a 50-year-old business, he said. I think it's not going to last. Why? Because pod shops are built on constant turnover. Traders operate like independent contractors. Relationships don't compound. Loyalty doesn't accumulate. And a firm that depends on replacing talent instead of developing it may not survive generational change. That's his cultural warning. But the systemic warning is bigger. Pod shops now sit at the center of modern liquidity. When credit spreads move, when volatility collapses, when tech stocks rally, when treasuries wobble, pod shops are part of the flow. They're not observers, they're plumbing. And that's exactly where the fragility appears. The pod model works beautifully when markets are calm. You can fire a PM, replace a team, reallocate capital, cut losses fast. But this same structure creates a hidden vulnerability. When markets hit stress at the same time, pods don't behave independently. They hit their risk limits together. And when that happens, diversification vanishes. Dozens of independent teams suddenly behave like one giant fund, all de-risking at once. That's the stampede risk. We saw early versions of this during the 2018 vol spike, the 2020 crash, and the 2022 rate shock. These weren't catastrophes, but they were previews. Moments where multiple pods were forced to cut exposure simultaneously, creating sudden air pockets in liquidity. Now imagine that happening in a world with higher rates, tighter liquidity, and larger pod shops. The next shock won't look like those past blips. It will be bigger. And here's the part most investors miss. You don't need to invest in a multi-strategy hedge fund to be exposed to one. If pod shops pull back risk as a group, your S&P 500 index fund feels it. Your tech stocks feel it. Your bond ETFs feel it. Your pension fund feels it. Your entire portfolio feels it. Because pod shops are now one of the largest sources of cross-asset liquidity on Earth. This is why regulators watch them. Not because they're villains, because their scale means a synchronized unwind can ripple into everything else. Dalio isn't predicting collapse. He's doing something harder. He's saying the model dominating today's market may not survive the environment we're about to enter. The last decade rewarded scale. The next decade will reward resilience, and scale and resilience are not the same thing. This is Macro Pulse, Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell. We're building the strongest macro community on the platform, one signal at a time.